US equities, in fact shares everywhere, seem to be running away with themselves right now. Is this healthy, and who wins? Other than, of course, those people who manage to sell before the price tops out. But what about the companies themselves and the broader economy? Even though Donald Trump keeps tweeting about how great it is that share prices are so high, is it really a good thing when share prices just keep getting higher? Does it actually do anything for productivity or economic growth? That's this week on the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. Welcome along. Well, we did get lambasted for last week's podcast on the Royals. It was too lightweight for some people, off topic for many others, and too pro-royal for the Republicans. So I think we satisfied no one. So let's get back onto safer turf this week. The US share market running away with itself right now, despite the trade uncertainty and a global economy that's showing very low levels of growth. The S&P and the Dow and the Nasdaq continually are hitting new highs, even if company profits aren't too hot. In fact, on Friday, we hit a new high in Australia on the ASX 200 as well. So we've actually seen a decline of almost 3% in S&P 500 profits expected for the fourth quarter of 2019, yet share prices continue to rise. There's understandably a lot of speculation that the US share market is overvalued. Why? Because really there's nowhere else for people to put money. But a broader question, what do shares do for business? They're used to incentivize executives, but does it produce the best results for the company or shareholders or for the businesses themselves? I mean, Steve, we've spoken about this before, haven't we? Share trades are transactions on the secondary market. Why would a company be so concerned about what price its shares sell for?
Yeah, I mean, one of my favorite cameo to start with here is with a observation on one of my very beloved brothers-in-law, who's a highly ethical man, and ditto for his wife, my sister, and they decided to set their own self-managed superannuation fund, and were very earnestly explaining to me, this is about 20 years ago, that they decided to buy a lot of Cochlear shares because they liked the research that Cochlear was doing, and they wanted to promote Cochlear's research into improving hearing in deaf people. And I didn't have the heart to tell them, you bought the shares off another speculator, not a cent of the money you're buying is going to Cochlear. But the picture that most people have is when they buy shares in a company, they're buying their shares off that company. And no, they're not. They're buying off somebody else, unless there actually is an initial share offering or a new distribution of shares. They're buying off somebody else who's bought the shares in the expectation their price is going to rise. And the person that bought it from obviously believes the share's worth less than they sold it for. They reckon they've capitalized a gain in some sense.
And yet we incentivize executives and companies based on share prices. Why do we do that if that's the case?
Well, this comes back to one of the wonderful pieces of wisdom and erudite thinking coming out of neoclassical economics, which is the idea of shareholder value. And it was an ideology that began in about the 1970s, 1980s, and it comes out largely out of the, I have a very hard time not finding insulting words these days, academics, let's call them, who developed what's called the efficient markets hypothesis. And they argued, as well as arguing that shares are efficiently allocating capital, that's the vision they have of the role of the stock market to efficiently allocate the world's capital. They also argued that there was a principal and agent problem between the managers of a corporation and its shareholders, because they said the objective should be to maximize shareholder value. That's the idea. So you should be trying to increase the wealth of your shareholders, however they might have acquired the shares, whether they bought them directly off you or they bought them off another speculator. You should be trying to maximize that over time. And to actually ensure that happened, you should reward the top executives of the company on the basis of the share market performance.
Right.
So you get people like, Steve Jobs is famous for taking just a $1 a paycheck per year, but his rewards were in options which only manifested themselves if the Apple share price exceeded target levels, which of course it did under his management. Now, he certainly was as objectionable a human being as apparently he was to work with, and I'm talking from friends with one person removed direct personal experience. he was successful in driving that company into new innovations and so on. So in that particular case, you can point to instances where that's the case. But then you get the majority of companies where what actually drives the share price is overall economic conditions rather than specific innovations in that company.
Yeah.
And
which is what we're seeing now. I mean, generally the share price is going up because money is shifting there because, well, perhaps a bit of false hope for the future, but also, there's no money being made in bonds right now, so they're looking for yield.
Yeah, and they're going anywhere for yield, and it is not a case that is actually generating research funds. In fact, when you again, I can't quote figures on this. I might be relying on you on that front at some point, but with your research
and the
data, not this time. Okay, but what you find is that the actual level of share issuing is less than the level of share cancellation, largely driven these days by stock buybacks, of course.
Well, I mean, this is the point. I mean, actually, I was going to get onto that because we are seeing a massive amount of share buybacks now. I mean, but part of that is because Donald Trump, helped companies repatriate their funds from overseas, and when they bought them back into America, they weren't really quite sure what to do with them, so they bought shares back in their own companies. But if my share price falls, because I'm still curious as to your idea that not your idea but your suggestion that the way it's seen is that I want to see my share price maintained because my duty is to try and look after the wealth of people who've invested in my companies, whether directly or indirectly. But it's in my interest actually, if the share price falls, that's an incentive for me to buy back those shares, and that's ultimately going to boost the price as well because we're reducing supply. So, I could do that rather than, and that's the opposite of really what capitalism wants to achieve, isn't it? Because rather than using that money to invest in expansion, I'm using it to buy back those shares to boost the value of those shares. And we're seeing that happening a lot in the US.
And that's a large part of what's been driving the share price. The other thing which has been driving it dramatically, and you can't ignore this, is the use of the central bank's quantitative easing program, because that QE has, in an indirect fashion, but it boosts share prices. In fact, that was the intention. And when you look back and see why did Bernanke copy what he thought was the way the Japanese went about the same story, that the Japanese did not do this, but that was to buy bonds off financial institutions, meaning that in the financial institutions' asset side, they had a fall in the amount of income-earning assets and an increase in the amount of cash. Now, as a financial institution, you are required to only buy financial instruments with that money. You're low performing because your income earning component's gone down, your cash component's gone up. What do? You go and buy shares. And you buy the shares. Of course, that's buying pressure to the tune of $1 trillion a year, effectively, because that was the scale of QE, $1 trillion a year of additional demand to buy shares. Well, it's certainly in America, that's driven the share price from, I think the share price bottomed at 666. That was the lowest level of the S&P after the financial crisis. 666, mark of the devil. I love it. What is it now? That's 3,200. I'm looking at the
Yeah.
So it's a factor
of 5. It'll be higher tomorrow, and it'll be higher the day after. The way it seems to be at the moment. Yeah.
And as you take a look at the long-term data, you can get data going back to 1927. If you look on the let's see, this is the Yahoo Finance site, and what you see is pretty much a flat line. I mean, from 1927 way out to 1975. But it starts about 1994, in fact. We even jump over the 87 boom and bust. And then you've got these three big peaks in 2000 and 2007, and finally the current one, which dwarfs the previous ones. And what has gone on, and particularly since Greenspan's role as central bank governor, he did the famous rescue of the financial system in 87. He got the job as chairman not very long before the stock market crashed 20% in one day. And his reaction was, we have to rescue the stock market. That was twice the scale of the fall of the Great Depression. the biggest fall in the Great Depression was 10% in one day. This is
so
20.
Are we preoccupied with the value of shares? Well, the US president certainly is, isn't he? Look, this is the first part of a longer discussion with Steve Keen. We talked for about 45 minutes. You've heard the first 9 minutes of it. If you want to hear it in full, you need to subscribe at debunkingeconomics.com or become a supporter of Steve Keen on Patreon. Go to patreon.com/Prof Steve Keen. If you pledge $10 or more, you'll get access to all of these podcasts. In fact, this one you would get access to if you pledged only $1 a month. So go to Professor Steve Keen at Patreon to get access to all of these. I'm Phil Dobbie. He's Steve Keen. We'll see you back here again very soon. Thanks for listening.